Thinking about selling your business? Office building, don't let taxes take a bigger bite than necessary. Smart tax planning can help you keep more of what you've earned. From minimizing capital gains taxes to leveraging special deductions, we'll show you how to structure your sale for maximum profit and peace of mind. Briefcase money bag, whether you're selling to retire, reinvest, or move on to your next big idea, the right strategies make all the difference. Stay tuned to learn how to sell smart and save big. Qualified Small Business Stock, QSBS, exclusion. Applies only to C corporations and excludes up to 100% of capital gains if stock is held for over 5 years. Gain exclusion is limited to the greater of $10 million or 10 times the stock's adjusted basis. The company must meet active business requirements. Ideal for small businesses planning growth before sale. Exclusion of gain from sale of primary residence. Applies if a portion of the business property also served as a primary residence for at least 2 of the last 5 years. Up to $250,000 for individuals or $500,000 for married couples can be excluded from the gain. The taxpayer must not have excluded gain on another home in the last 2 years. Ensures partial exclusion for mixed-use properties like live-work spaces. Rollover of gains for ESOPs. Allows sellers to defer capital gains tax if selling stock to an employee stock ownership plan, ESOP. The business must be a C corporation, and sellers must own at least 30% of the company. Provides a tax-advantaged exit strategy for business owners. Installment sales to spread taxable liabilities. Spreads taxable gain over several years as payments are received. Reduces immediate tax burden for sellers, improving cash flow. Does not apply to inventory, marketable securities, or dealer property. Depreciation recapture for real property and personal property. Gains due to real estate depreciation are taxed at 25%, higher than capital gains rates. Sellers should calculate recapture obligations before selling. Gains attributable to depreciation of machinery or equipment are taxed as ordinary income. Sellers should identify all depreciated assets during negotiations. Allocation of purchase price in asset sales. Requires the purchase price in an asset sale to be allocated into 7 IRS categories. Buyers and sellers must agree on the allocation and report it on Form 8594. Allocation affects the buyer's depreciation and the seller's tax liability. Goodwill and intangibles are taxed at capital gains rates, while inventory is taxed as ordinary income. Seller needs to negotiate right and plan ahead. Business property sales. Gains on business use property are taxed at favorable long-term capital gains rates. Losses on business property are treated as ordinary losses, which are fully deductible. Applies to property held for over 1 year. Ideal for businesses selling large, depreciated assets. Net investment income tax, NIT. Imposes a 3.8% tax on net investment income for individuals earning over $200,000, $250,000 for couples. Includes capital gains from the sale of a business. Does not apply to active business income unless the seller is passive in the business. Requires sellers to plan for additional tax liability during M&A transactions. Can be mitigated through strategic tax planning. Don't leave money on the table. Take control of your business sale with smart, effective tax strategies that maximize your profit. Contact us today to get personalized guidance and ensure a smooth, financially sound exit from your business.